Understanding your critical financial numbers may not be as exciting as making a big sale, but keeping an eye on these figures will give you precious peace of mind and a glimpse of what the future holds for your business. 1. Total inventory. Monitor your inventory numbers on a weekly basis to ensure that the amount of inventory isn't gradually increasing, as this could be a sign of sales trouble. By tracking inventory on a regular basis, you can spot problems early enough to avoid the negative effects of excess inventory, which includes storage costs, reduced profits, and potential waste. 2. Seasonality. Seasonality is a measure of how the period of the year is affecting your company's financial numbers and outcomes. If you're in an industry that's affected by high and low seasons, this measure will help you sort out confounding variables and see the numbers for what they truly are. 3. Operating cash flow. Operating cash flow is a measure of how much cash the business has as a result of its operations. This measure could be positive, meaning cash is available to grow operations, or negative, meaning additional financing would be required to maintain current operations. This figure is computed by subtracting your operating expenses from the money your company generates during normal business activities. It includes depreciation to your net income and adjusts for working capital like receivables and inventory. When your operating cash inflow exceeds your cash outflow, this is a sign that you're operating in the black. If the reverse is true, it's time to take a closer look at your income and expenses. Sufficient cash flow in your business checking accounts, especially payroll accounts, is critical. Small business owners should always make sure they have the necessary cash flow to meet all monthly business expenses. It provides a view of a company's overall liquidity by showing cash transaction activities. It reports all cash inflows and outflows over the course of an accounting period with a summation of the total cash available. Standard cash flow statements will be broken into 3 parts: operating, investing, financing. 4. Net income. Closely related to cash flow is your net income, which is also known as your net earnings and net profit. This figure constitutes the result of subtracting all your expenses, including taxes, from your income. It's not adjusted for items like depreciation. Like cash flow, your net profit is a good indicator of whether you're earning or losing money. 5. Profit and loss. This figure is found on what's commonly known as your P&L statement, which is a snapshot of your company's income, sales, and revenue, minus expenses during a specific period of time, which is generally quarterly, every 6 months, or yearly. Knowing your company's profit and loss over time allows you to project earnings and make realistic plans for the future, both short-term and long-term. 6. Sales. Given that generating sales is the reason most entrepreneurs operate small businesses, this figure is the most critical in the numbers list. Keeping a close eye on sales is important, as a dip could be a warning sign of trouble. In the same respect, it's important to pay attention when sales are up. Determining why business is good at the time your company's on an upward trajectory is easier than trying to figure it out later. Reacting quickly to an increase in sales also allows you to determine what you need to keep doing to sustain that growth. 7. Gross profit margin. Gross profit margin is a profitability ratio that measures what percentage of revenue left after subtracting the cost of goods sold. In short, this figure reflects how much money remains after the actual cost of your merchandise is subtracted from the selling price. The cost of goods sold refers to the direct cost of production and does not include operating expenses, interest, or taxes. In other words, gross profit margin is a measure of profitability, specifically for a product or item line, without accounting for overheads. If this figure is low and not sufficient to cover your operating costs, such as salaries, rent, marketing, and utilities, then you're likely not charging enough for your products and services. Gross profit margins, revenue, cost of sales / revenue 100.